Let's get more from Mark Fuchs. He is the CEO of Fuchs Capital Partners, an equity long-short hedge fund which focuses primarily on Southeast Asia. He joins us right here on the set. Mark, thank you for coming back on Squawk Box.
Good morning.
I know that your fund focuses on Southeast Asia, but you cannot help but look at what's happening globally. What do you think is going on right now?
It's a very interesting time, to put it mildly. There's two things happening in the markets right now. The first element is regarding fear and dislocations in the credit market and liquidity aspects, and then secondly is a more fundamental aspect to earnings and the projections thereof. With regards to the first aspect of fear and dislocations, you see a bifurcation in credit where the authorities are attempting to pump in a lot of liquidity, but at the same time, when you look at things like the TED spread, which monitor the actual LIBOR over the risk-free, it's blown out to over 4% spread, whereas it was 1% 2 months ago. So that's a huge shift in the inability of the transmission mechanism to inject that liquidity. And so that dislocation is not allowing banks to function properly. Now, the Fed's entering in the commercial paper market to essentially underwrite unsecured lending hopefully will help, but nevertheless, there is a huge element of dislocation of where the liquidity should be, and it's not actually getting to the economy. So as a result, people are selling. More fundamentally, however, there is an aspect of earnings reality check. As early or as late as a couple of weeks ago, people were projecting 10–15% earnings growth both in the U.S. and in emerging markets. That is a very, very optimistic call given the way situation will be, and as such, I think that people are taking money off the table.
You know, can you explain to me, how do we get to this point, though, of where we were in a bear market and there were concerns about the economy in the U.S. and this liquidity issue? These have been around for, you know, not a while now, several months at least. How do we get from that kind of bear market, you know, pulling back, I should say, to what looks like right now a full-on flee the market scenario, sell down, get out of your holdings if you can?
I don't know if there was a specific catalyst as such, but there was a building up of problems and pressures, namely the over-leverage of the U.S. consumer. And remember, the U.S. being the largest economy and the largest component of that economy being consumption, clearly had reached a point where it was an unacceptable level. Banks started to take in that credit, consumers were less able to spend, and as such, you started to see the deleveraging process through the failure of banks, and then that accelerated given the leverage in the financial sector. I think one of the things that's important to note is that we're going to see a re-regulation. You know, normally regulations occur not in a linear form, but in a series of advances and retreats. And right now we're in a situation where you'll see a re-regulation, which means financial services as a percentage of GDP in many of the larger developed economies will probably go down.
To talk about what we're seeing in the markets right now and trying to understand what exactly is going on. Listen, Mark, you mentioned earlier that there is a fear in the markets right now about the liquidity issue and also about corporate earnings as well. Let's tackle the first one if I can. If central banks and governments have been out there pumping liquidity into the money markets, if they're announcing bailout packages and nationalizations of banks, and these things, and they're cutting interest rates coordinated globally, and these things are not working, what is going to work?
Well, it's an interesting question. I actually think one of the problems is that not that the Fed isn't providing, or the other central banks aren't providing the ability to liquefy, it's just that the banks aren't lending to each other, and that's the reflection of why the TED spread is blown out. My suggestion would be a potential implicit or explicit guarantee of interbank lending. So if central banks were to somehow stand as a backstop between interbank lending, that may actually provide the willingness to lend where currently they're not.
Okay. What would you be advising people to do right now? I mean, when you look at what's happening in the markets, it gets pretty nervous, pretty scary out there, so to speak. I know your call has been on gold for quite some time. Is that still, having gone up past 900, still attractive to you?
In some ways, I'm sad to be right, because the way it's gotten there has been a very dislocated way. But nevertheless, I would continue to recommend gold for several reasons. Firstly, when you look at gold, it's obviously a store of value, flight to safety, which is top of most people's lists of concerns now. Secondly, look at the fundamentals of real interest rates right now. You've got inflation in the States at least a couple of percent, whereas interest rates are probably going to go to 1%. So flat to negative real interest rates is typically very positive for gold, usually at least 10 to 20% upside in a flat a real rate environment. Thirdly, when you actually look at the marginal cost of production on a fundamental basis, it's about $700 to $750 an ounce. So we're not that much above where it simply costs to produce gold. So I think the combination of those factors, coupled with the fact that the huge liquefaction that's happening, trillions of dollars are going to be put into the economies. As such, that's very, very supportive for a, quote, store of value. And I think gold could go considerably higher from here.
Mark, if you are a risk-averse investor, you want to get in on gold, I have been hearing that increasingly people are electing to buy the physical commodity, the bullion, the gold bars, the coins, which are running out because of this demand. Is that the way you play it, or is it by through the SPDR Gold Trust, the ETF, or the gold mining companies?
I guess probably a little bit more on the ETF side for any institutional investor, simply because there's a lot of liquidity. The gold ETF is certainly among the most liquid aspects for both retail and institutions to get exposure. If you're buying gold bars, if you go to the local bank, for example, your bid-offer spread is about 10%. So that's a pretty tall ask, even in this environment, to simply say you're going to lose 10% by simply owning the physical, unless you're really looking at a doomsday scenario, in which case perhaps physical may be more warranted.
I just want to get back to the broader market sentiment, Mark, and we got G7 meeting. There's speculation that they may announce more confidence-building measures, including this guarantee of interbank lending. If they do decide to do that, how big of a positive tailwind, rather, is that going to be for market sentiment?
Well, I mean, I think there's always an element of sellers' fatigue and buyers' fatigue in any kinds of rallies or meltdowns. So clearly, any kind of a coordinated effort which has serious teeth, such as interbank guarantee, is something that would be quite material, may result in people wanting to liquefy or even express positions in the market. However, the reality of the earnings fundamental, I would draw back to that you're really looking at expectations that are well ahead of where perhaps the economies will be going, to assume that emerging markets are going to be growing at 10, 15%, and even U.S. at that kind of EPS growth is probably optimistic. So I think there could be a bounce, but you probably still have a little bit more downside on the fundamentals.
Okay. Mark, the Asian economies can't always wait for G7 to decide what to do on a global basis. What can governments, and what have you been seeing central banks in the region do to either try and shore up their currencies, or at least to some extent protect the capital flight that we're seeing?
I think that Asian central banks have a huge amount in their toolkit to actually respond to this problem. They've got, in many instances, current account surpluses. They've got, in many instances, huge foreign exchange reserves which rival or exceed most of the European countries' reserve base. And as such, I think that they have got a lot of ability also to expand fiscally through fiscal stimulus. So given the limitations in budget problems, I think that they've got actually a huge range of things to actually do to stimulate economies.
If they were to intervene in the currency markets, for example, which we know the authorities have been, especially in South Korea, they do have that firepower, right? But is that going to be enough then to at least help the local economies, which are worried? Singapore, for example, just downgraded its GDP forecast for the year. It is in a technical recession right now, so it is not immune. Asia is not immune to this global slowdown that we're seeing. What can the governments do to try and buffer that?
Well, they can support the currency to prevent volatility. But I would argue for anybody that's got a longer-term view that all the liquefaction that's actually happening, essentially printing of money in the U.S., etc., many of the Asian currencies probably are attractive medium-term. And what you're seeing on pressure now is simply a result of liquefaction of emerging market investment bets going back home. But ultimately, when the dust settles, the realization that the macroeconomic situation in the very places that they may be removing those currencies is actually more positive than holding dollars.
Let me get to a viewer email that we got right here, and we can throw this up. It's from Desmond, and he's asking a three-part question. Okay, it's a bit long. Is the deep cause of the global economic crisis the now unprecedented and unsustainable level of national debt of the USA? He's also asking, have South American nations repudiated their debts at lower levels? And is a run on the dollar by the foreign creditors a possibility? Let's start with the last one first.
Well, I think that, of course, anything is a possibility in financial markets, but thus far, there's been a propensity of purchasing both longer-dated paper out of the U.S. as well as the scramble for short-term liquidity in the T-bills, etc. I think that what will more likely happen is over time, any incremental purchases of fixed income paper will probably not be as targeted in the U.S. And what that will do is result in a ever higher increasing rate of interest because of the unsustainability of buyers in that market.
Okay, in about 30 seconds or so right now, if we're invested in Southeast Asia specifically, where you focus on, what's your biggest advice?
Well, right now, obviously, caution. They will be affected. To assume that they are immune is not correct. But over the medium term, there's a lot of values in many countries.
So look out for those values then.
Yeah.
Thank you very much, Mark.
Thank you.
Appreciate it. Mark Fuchs from Fuchs Capital Partners, the CEO of that, joining us here.